Zoetis has long been regarded as the gold standard in animal health, built on nearly 75 years of innovation and a broad portfolio serving veterinarians and pet owners in more than 100 countries. But the latest earnings reveal why that reputation is now being tested. Management said lower clinic visits, greater pet owner price sensitivity, and heightened competition are pressuring the companion animal market. U.S. companion animal revenue fell 11% in the second quarter, while the company cut its 2026 outlook. My analysis is that the real issue is not one weak quarter. It is whether Zoetis can still turn brand strength, innovation, and market leadership into profitable growth when the customer becomes more price conscious. That is the test we need to understand. And to understand whether that advantage is really weakening, we first need to understand why Zoetis earned the crown in the first place. But before we ask whether Zoetis is losing its crown, we need to understand why it earned it. Zoetis built its leadership through science, scale, customer relationships, and a remarkably broad portfolio. The company sells roughly 300 product lines across more than 100 countries, covering 8 core species and 7 major product categories. Its 2025 annual report says its large sales organization, veterinary specialists, manufacturing capabilities, and long track record of developing products for customer needs have created enduring relationships. My analysis is that this is the real moat, not dependence on one blockbuster, but a system connecting innovation, distribution, customer trust, and portfolio breadth. That system is what the latest earnings are now putting to the test. But a strong moat only matters if it can keep working when the market becomes more difficult. Zoetis did not lose its growth model. The evidence shows that the model worked until the U.S. pet market became harder to grow. In the first quarter, international companion animal revenue still grew 7% organically and livestock grew 12%, while U.S. companion animal fell 11%. Management attributed the U.S. weakness to softer demand, fewer veterinary visits, price sensitivity, and stronger competition. By the second quarter, the same pressure remained, confirming that this was not simply a one-quarter disruption. My analysis is that the underlying model is still functioning, but its most important growth engine is no longer providing the same support. That changes the question from whether Zoetis can grow to whether it can restore growth in its core U.S. franchise. And that brings us to the most important question: why is America, once a major source of strength, now where the moat is being tested? The latest results make one point clear: Zoetis does not have a company-wide demand problem. The pressure is concentrated in the United States, where revenue fell 7% and companion animal declined 11% in the second quarter. Meanwhile, international revenue grew 6% organically and livestock revenue increased 11%. Management said the U.S. weakness reflects softer clinic traffic, affordability pressure, and intensifying competition. My analysis is that this divergence matters because it shows the broader Zoetis franchise still has growth capacity. The immediate challenge is whether the company can repair its largest market before weakness spreads further. And that takes us directly to America, where the moat is now being tested. America is where Zoetis faces its biggest test because premium animal health products now meet a more cautious customer. In the second quarter, U.S. companion animal revenue declined 11%, and management linked the pressure to lower clinic visits, greater price sensitivity among pet owners, and heightened competition. Zoetis said these conditions affected several key franchises. My analysis is that this creates a tougher test for pricing power. A premium brand can defend its position when customers are willing to pay for better outcomes, but weaker traffic and affordability pressure can change that equation. The key question is whether Zoetis can preserve its differentiation without sacrificing volume or profitability. And the clearest place to test that question is dermatology. And that is why dermatology matters so much. It is where Zoetis now has to prove that its premium innovation still deserves a premium price. The customer equation has changed for Zoetis in the US. The company says price sensitivity is affecting demand for key dermatology products, while competition has intensified. That matters because dermatology was built around differentiated therapies that veterinarians and pet owners were willing to pay for. In the second quarter, the dermatology franchise declined 16%, with pressure tied to softer demand and promotion-driven competition. My analysis is that this is less about customers suddenly rejecting Zoetis products and more about the threshold for treatment becoming harder to cross. When clinic traffic falls and budgets tighten, even strong innovation faces a tougher value equation. The real test is whether Zoetis can defend share without relying too heavily on promotions. And when that pressure reaches one of Zoetis' most important franchises, the next question is whether the same problem is spreading to Simparica. Simparica shows why Zoetis faces a competitive test. In the first quarter, the US Simparica franchise declined 8%, while Simparica Trio fell 8%. Management said additional entrants and promotional activity were taking share, while weaker clinic traffic reduced the benefit of market expansion. By the second quarter, the Simparica franchise was flat, showing stabilization but not a return to growth. My analysis is that innovation remains a defense, but it no longer guarantees category expansion when competitors use discounts and bundled offers. Zoetis can defend share, but doing so may require investment and weaker price realization. The question is whether this defense can restore growth without changing franchise economics. That is why we need to look beyond Simparica. And this is where the Zoetis story becomes more nuanced. The second quarter showed that the weakness in U.S. companion animal does not define the entire company. International companion animal grew 5% organically, while international livestock grew 6%. In the U.S., livestock was even stronger, rising 23%. Diagnostics also continued to contribute, while new products such as Lenivia and Portela expanded the portfolio internationally. My analysis is that this diversification gives Zoetis an important buffer. A weak U.S. pet market can pressure growth without destroying the economics of the broader franchise. The moat is under pressure, but the evidence does not support calling it broken. And that distinction matters when we look at what management is doing next. Management is not treating the current weakness as something the market will simply solve. In the second quarter, CEO Kristen Peck said Zoetis is adapting its commercial strategy, deploying targeted investments, accelerating innovation, and pursuing business development. The company also highlighted more than 12 potential blockbuster candidates and continued major market approvals. My analysis is that this response reveals a deliberate two-track strategy: defend existing franchises today while building new sources of growth for tomorrow. That is encouraging, but it also raises a key test. If Zoetis must invest more to defend share while demand remains weak, the company has to prove that those investments can eventually restore profitable growth. And that brings us to the pipeline. And if management is building for tomorrow, the next question is whether the pipeline is strong enough to replace the growth that is fading today. This is where the long-term Zoetis story becomes interesting. The company has more than 12 potential blockbuster candidates across chronic kidney disease, oncology, cardiology, anxiety and obesity, and management remains committed to a significant major market approval every year for the next several years. Recent launches of Lenivia and Portela also show the pipeline is moving from research into commercial products. My analysis is that this gives Zoetis a credible path to replace aging growth engines, but it is not yet proof of a recovery. New products must scale fast enough to offset pressure in existing franchises. The real question is whether innovation can arrive before competitive pressure becomes a lasting drag on growth. But a strong pipeline alone is not enough. We need to know what evidence would prove that the moat itself is still intact. So what would actually prove that Zoetis still has a durable moat? I would watch 6 signals. First, U.S. companion animal demand must stabilize. Second, dermatology must stop losing share while maintaining its leading position. Third, Simparica must return to sustainable growth rather than relying mainly on promotions. Fourth, pricing pressure should moderate without sacrificing volume. Fifth, international growth and diagnostics must continue offsetting U.S. weakness. Sixth, new pipeline products must begin scaling into meaningful revenue. Zoetis remains the clear U.S. dermatology leader, with about 86% in clinic share in the second quarter, but that share fell 5 points sequentially and 10 points year-over-year. Zoetis, my analysis is that the next few quarters will reveal whether the moat is recovering or merely being defended. And that leads to the final question. And that brings us back to the question we started with: is Zoetis still the gold standard of animal health? So, is Zoetis still the gold standard? My answer is yes, but with an important qualification. The latest evidence does not show a broken franchise. International companion animal continued to grow organically, livestock remains strong, and management is accelerating innovation with more than 12 potential blockbuster candidates. But the United States companion animal business faces pressure from weaker clinic traffic, price sensitivity, and stronger competition. Zoetis is responding with targeted investments, commercial changes, and new products. My analysis is that the moat remains intact, but investors are no longer willing to take it for granted. The market wants proof that Zoetis can stabilize its core franchise and turn innovation into renewed growth. That proof must come next. And that is the real Zoetis story. The crown has not been taken away, but the next chapter will determine whether it still deserves to be worn. The investment insight is that Zoetis is no longer a simple quality story. The company still has the scale, portfolio breadth, international growth, livestock strength, diagnostics momentum, and innovation engine that support a durable moat. But the latest earnings show that its core U.S. companion animal franchise is under pressure from weaker clinic traffic, greater price sensitivity, and stronger competition. Management is responding with targeted commercial investment, pricing actions, and a deeper pipeline. My conclusion is that the moat remains credible, but the market is right to demand proof. The next phase of the Zoetis story will depend less on defending its reputation and more on restoring sustainable growth. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.